Assalamualaikum and hello everyone. Welcome to my channel. Today we are going to discuss one more question, which is on question 1 for the preparation of financial statement, the published account, and this is specifically for the FAR270, and this can also be used for FAR460, and anyone that would like to learn how to prepare the published financial statement at an intermediate level. So we have a question here which I call a sample FAR270 August 2021, because this is done for the final touch-up for your question 1, which is going to be 30 marks for this upcoming exam. And you have the information here. Ebony is a company incorporated in Malaysia. So we have the information that this is a Malaysian company. The following is the trial balance as at 31st of December 2020. So that is the reporting date, and the financial statements are authorized for issue on 1st of April 2021, and this is the authorization date. So take note on that information, and you have the details here. So these were the information taken from the trial balance. So you have this information that relates to equity, the income, expenses, and liability. So the first thing that you need to do is always to read the requirement. So let's look at the requirement. You are asked to prepare the following financial statement, which is in accordance with the relevant Malaysian financial reporting standard, which is also word forward the same as per the international financial reporting standards. So this is also relevant for those who are also interested to learn published financial statement at an international level as well. So we have these requirement, which is to prepare the statement of profit or loss and other comprehensive income, that is for 10 marks, statement of changes in equity for 4 marks, and the statement of financial position together with the notes to the property, plant and equipment, that one is for 16 marks. So we need to say that this part comes with the highest marks, which is the statement of financial position with the accompanying notes on property, plant and equipment, and the total mark is 30 marks, which is going to be the same marks allocated for FAR270. So as I have mentioned, this is taken from FAR460, but I've excluded MFRS 141, which is on agriculture, to suit the requirement of FAR270. However, it is also relevant for those who are interested to learn in detail about the step-by-step to prepare published financial statement. So the first thing that you need to do first is always to classify, as I've always mentioned in my videos. These are the things that you need to classify. So therefore, what you need to do when you classify means you need to classify them according to the expenses, income, right, assets, liabilities, and also equity. So if you can see here, I've already classified that for you. The ordinary shares, retained earnings, asset revaluation reserve, and the interim dividends, these are equity that will appear in the statement of changes in equity. The non-current asset here, you can see that all the asset, the PPE, and also the IP is non-current asset as well, but only that is under the MFRS 140. Yeah, be careful with that in case you may have confused that with an item of PPE. Next one is the non-current asset, which I put here negative non-current asset. This is because accumulated depreciation is a contra asset account, so that is going to be deducted against the PPE. So the PPE, land, building, plant and machinery, will have to be adjusted for this. Of course, land will not be depreciated. Right, then you have your trade receivable, your inventory. So make sure you do that correctly. Bank account, we need to do some adjustment. This one is a non-current liabilities. Right, bank loan, if that is going to be repayable within more than 1 year. This is income, more specifically this is revenues, and MFRS 15 IA, sorry, the IFRS 15 as well. So this is expenses, all these expenses, right? So here is the information that you need to take into consideration. So my suggestion is, before you start preparing the financial statement, why not do the adjustment? So let's do the adjustment. Here you can see that I have already prepared the information here, where you will see this is going to be your adjustment. Before that, the first information is on PPE. Building is to be depreciated. So I'm using a highlighter. You can see that my turquoise is for my building, and building is using a revaluation model. So if there is any changes in the fair value, so the changes will be accounted for under FAR160 revaluation model. For plant and machinery, that is using cost model, depreciation 10 years, the straight line method. But if there is any changes in fair value, that will be ignored. So it will not be accounted for if it is using cost model. Investment property is measured using fair value model. So if under fair value model, there is no depreciation, there is also no impairment. So that is just for you to take note the changes in the carrying value versus the fair value, and that will be taken to the profit or loss, either as an other income or maybe as an expense. So we'll see this. So I've put the different color there, highlights of yellow, and for the plant machinery that was green. And you have the first information there, and that is for you to take note. So for building, you will see that in the second information there's another information on building. So I'm not going to do the building information straight away. I'll be doing things which are simpler first. So I'm going to do information regarding plant and machinery. I will skip for a while KIV, my building and investment property. So let's just do the information number 1, additional information, the adjustment for the depreciation. So if you see here, what you see here, I have already done the adjustment for depreciation for building, sorry, for plant. Plant, if you see, it was 10 years. So you will take the cost of the plant. Here you have the information at valuation, right? So you will take, that is for building and land. But for plant, it is at cost. So 5.88 million and 1.4 million is the cost, right? There are no changes to the asset. If there are changes in terms of acquisition, disposal, you need to take into consideration, but here none. Make sure you check all that so that you don't make mistakes. Here the depreciation would be 5.88, which is this figure, this one, right? And that will be divided by the useful life. The useful life is the useful life here, 10 years. So that is going to give you 588. Okay, 588. Right. That will be later shown in the working. So if you prepare the workings, you normally prepare the workings, right? So prepare that workings so that depreciation on plant and machinery and on plant and machinery should be done separately. So I'm showing you the figure here. Right, let's see that. Okay, it should be 140 for the machinery, because 1.4 million, this figure, 1.4 million divided by 10 years. Okay. And the second one is plant would be 5.88 divided by 10 years, and that was for just 1 year. So if you want to do the journal entry, I would say don't do it in the final exam, but just proceed doing the workings. But this is just for revision purpose, right? So if you were to do it quickly, you will be escaping the or will be skipping the adjusting journal entry 1A and 1B. You can straight away do the workings. Next one is done with that, and now we're going to do the second part, which is the adjustment relating to item building and also adjustment on building here is because there was a revaluation, and as well that is done also for land. So 1st January 2020, the land and building, look at the date. When you look at the date here, the date is on at the beginning of the year. So if it is done at the beginning of the year, so what you need to do is you need to do the adjustment at the beginning of the year. What the first thing that you need to do, if it's for land, no problem, you just compare the land which is at valuation, meaning that it has been revalued before. That's why you have land at valuation. It was 15,850, no depreciation, right? And that has to be compared, I'm doing for land, with 15,500. So for land, you would see that it has been informed here, the asset revaluation reserve, this part here, right? Asset revaluation reserve in the trial balance, it relates to the surplus on revaluation of the land that was previously being revalued. So meaning to say that this is the second revaluation. So the first revaluation here that you can see the balance here, this one relates to land. So that relates to land, and therefore if there is any surplus or deficit, you need to go and check whether do you need to go and what is the guideline under MFRS 116. Okay, just put some highlight there. So asset revaluation reserve has 7 to 9, and this 7 to 9 is exclusively for land. How do I know? Because the question clearly informed you that was related to land. So if you have a revaluation, let's say I have been doing here, you are going to set off that deficit that you will come across in a short while against the revaluation reserve balance. So if you look, the carrying value was 15,580. The carrying value is 15,580, whereas the fair value was 15,550. So it is there is a decrease or a deficit on the revaluation of land of 350,000, and because this is a second revaluation, that deficit will be set off against the ARR, or the land revaluation reserve balance, which is related to the land. And the 7 to 9 will be used to offset the revaluation deficits. By how much? By 350,000, and that will be credited to the land account. And this also need to be reflected in the other comprehensive income in your SOPL, as well as other comprehensive income in the statement of changes in equity. So it has to be done here. Oopsie daisy. It is actually here. Okay, you need to show that here, deficit, because you offset against the previous revaluation surplus. It also needs to be shown here in your asset revaluation reserve. It has to be reduced with the balance that were available for the ARR, right? And that was 7 to 9. What you offset is 350,000. Okay, that was for land. Now let's look at the building, and and for land just now, sorry, you also need to do that in your PE notes, but I will leave it later. I will leave that later. Let's just go and do our building. So building, they was being revalued the first time, and these have not been recorded. So we need to go and record. The building was revalued to 4.8 million, and you need to compare the fair value here with the carrying value. And the building has a remaining useful life of 25 years on the date of revaluation, meaning that on 1st of January 2020, the remaining useful life was 25. So let's see what we need to do. Okay, for the revaluation of building, I put as 2B because 2A I have already included that as my land revaluation. Now this is the building revaluation. Remember, building is a PPE here. So 1st of January 2020, which is on the date of revaluation, you need to go and eliminate the accumulated depreciation on the revaluation date of the building. Here the whole building has been revalued, the whole building. So if you look at the building here, this 15850, the whole building is being revalued. So the whole accumulated depreciation of the building must be eliminated. The one that is on the date of revaluation, which is on 1st of January 2020 at the beginning of the current reporting date period. Okay, so here you will debit accumulated depreciation building 540,000, which is this figure here. You don't have to calculate, that is given, and credit building. So when you do this, you need to do that changes or reflect that in the notes to the PPE. We'll be doing that later. Second one is to record the valuation surplus. How do you record the surplus? Of course, the surplus, if it's the first time, you will debit the building and you go and credit the ARR of the building, right? How much? How much you need to go and compare the fair value. Fair value was given here, 4.8 million, right? And you will compare that with the carrying value on 1st of January 2020. The carrying value is not 5080, but the carrying value will be 5080 minus 540,000. So that is being done here. 5080 minus 540, you have 4540 or 4.54 million. That is the carrying value on the date of revaluation. I put here DOR, date of revaluation. And when you do that, you will have a surplus, which is the initial revaluation, 260,000. So that is how you get it. And make sure you will go and show that in the correct statement, which is the statement of profit or loss, the statement of changes in equity, and also showing that in the movement in your PPE notes. So let's see, this is the surplus of the building, 260, and that is also shown here separately. You cannot offset surplus and deficit of a different asset, or of a, this is not allowed, right, under MFRS 116. Okay, that would be the amount that you will show would be 260,000, right? Next is to do the information on depreciation. Remember, building will continue to be depreciated, but the building will be depreciated starting from 1st January 2020. It will be depreciated based on the new value, which is the fair value, 4.8 million. So from there onwards, the depreciation of the building will be 4.8 divided by 25 years times 1 year, because I'm calculating the depreciation starting from the date of revaluation. The date of revaluation is on 1st of January 2020, the date of revaluation, right? And therefore the information here, if you can see, depreciation building 192. How do you get 192? The carrying value divided by the remaining useful life, and you were informed that the remaining useful life on the revaluation date 25 years. So I am doing the depreciation for 1 year, so that is why I multiply with the figure here was going to be 192. Carrying value on the date of revaluation divided by the remaining useful life on the date of revaluation. Next, and don't forget to include that depreciation in the working section, yeah, as you get that. So this is going to be here in the working section, right? Next one would be your item on investment property. So this is under MFRS 140. 1st of October 2020, the company acquired the company acquired new IP amounted to 750,000 and paid in cash. This is not a transfer, but this is a new acquisition. So if you pay in cash, you go and debit your investment property. If it's a building, it will be building. If it's a land, it will be a land. It can be under IP, it can be under PPE, but here it is under investment property. So debit investment property, it will be shown separately in the non-current asset section later, 750,000, and that you will credit bank. You have to adjust bank account in your software under current asset, 750,000. That will be shown later when we prepare the software. Next, you have the second sentence, which I put it as 3A and 3B. 3A is the first part, 3B is this second part. As at 31st of December 2020, the fair value of IP, including the newly acquired investment property, is 2050. So this is the fair value. And this valuation also has not yet been recorded. So the valuation has not been recorded. The transaction of acquisition for cash also was not recorded. So you need to record. So when you record, you are going to compare the fair value. You can see what I've done here, fair value 2050 with the carrying value. The carrying value will not just be 1.2. You can see here the investment property is 1.2. That is true on 1st of January 2020. But you were informed in information number 3 that there was a new acquisition on 1st of October. So therefore that 750,000 must be added to the balance at the beginning of the year. So that new IP that you purchased for cash will now give the carrying amount of 1950. So compare this 2050 with 1950, you will have a fair value gain of 100,000. Do not go and credit that to the ARR. These are the mistakes that students need to always, try to avoid. That is not an item under PPE. So that shouldn't be be credited to the ARR. It has to be credited to the gain on fair value of change of IP, which will be in your SOPL. You can also include that under other income, but here I'm showing that separately later as a line item in my statement of profit or loss. So debit investment property 100,000 with the fair value change, gain on fair value change, or the increase in the change in IP, increase in fair value of IP, and 100,000. And remember, your IP later that will be shown in your statement of financial position will no longer be 1950, it will be 2050, the fair value. There is no depreciation for you to adjust. Do not adjust depreciation. This is using fair value model. How do you know? Here, this is the information telling that it is using fair value model. But if it's using cost model, yes, you need to go and adjust the depreciation. So now we go to number 4. This is easy. Number 4 is just information on inventory that has been obsolete and damaged, and you need to go and write off. And that happened to be the one that was discovered on 1st of February 2021. So this is before the authorization date. Remember, authorization date was 1st of April. So if it's happened before the authorization date, this is also going to be accounted for under MFRS 110, events after reporting period. Right, so you go and treat that as an adjusting entry. So being an adjusting entry, debit cost of sales in the SOPL at that 10,000 credit inventory, and the inventory must be reduced by 10,000 later in your software. Next, we go to number 4. Number 4 is the information. Number 4 we have done, right? Okay, number 5 is on loan. This is some just accrued adjustment. So for that part, loan interest is still outstanding. So if you check the loan, there was a loan interest that has been provided, interest on bank loan 380, but still there are some amount that is outstanding. If you want to know what is the outstanding amount or what is the accrued amount, you will take 8% times 6 million, and then that will give you the total for the interest for the year, and you need to deduct the interest on bank loan 380. So here I've done the workings, 8% times 6 million, and that was for 1 year, minus the one that has been provided, minus the one in the trial balance. right? The one in the trial balance. 380,000, so you have 100,000. So this must be shown as your finance cost later in your SOPL. So I've shown that here, 380 plus 100. So for the selling and distribution, that it is just as per the trial balance. There are no other additional selling and distribution. So now you get all your total for your admin expenses correctly. So what we can do now is that we can now total up, and this should be your total, and you can transfer that figure later for your selling and distribution as well as for your finance cost. So let's just put that here, selling and distribution and finance cost. Next one, I'm still doing my adjustment, remember. In September 2020, the board of directors has approved for the company to perform a minor restructuring exercise. So there was an approval done by the board, and this is actually an adjustment under FAR137, which is on provision, contingent liabilities and contingent assets. And the planning was communicated with the affected employees. So here the estimates are being reliably made for this restructuring cost of 888,000 or 888,000. However, no related costs have related records have been made. This is a provision because the outflow is probable, because that is the case where directors has approved for that exercise, and there is a present obligation, and at the same time there was a cost that has been reliably estimated for the restructuring cost of 880,000. So this is an adjustment under MFRS 137. So you can check the adjustment that I put here to recognize provision for restructuring. You're going to debit restructuring cost. You have an option. Either you can put under admin expenses, or you can also put that under other operating expenses, right? I'm putting it under admin. So I will put 888,000 to add to the admin expenses. Credit provision for restructuring, right? Because this is going to be your current liabilities, 888,000. So that provision for restructuring will add more to the expenses here. When that happens, you have now your admin expenses to be 4698. And you also will see that the gain in fair value change is also shown here. You can also put as part of other income. That is also fine as long as you show the detailed workings. Remember, you must always show the detailed workings for all your expenses and for all the details that you have here. Do not show the details in the statement. Show the details separately. Do not go and show the addition of admin expenses here. Show them at the bottom or just on the right hand side of it. Do not go and mess up your statement of profit or loss. Right. Next, we go on number 7. Number 7, tax expense. This is informing you the tax expense charged in the SOPL is 1 million. And you need to go and check whether there is a tax recoverable or tax payable. So if you check tax expense, debit tax expense in the SOPL 1 million, there was a tax paid earlier, so it was a debit balance. So now I credit tax paid 1050, and the difference between tax expense, what you are charged and what you have paid, have been more than what you have charged. So that is a recoverable amount of 50,000. That will be your current asset. So done with the adjustment. Let's now do the preparation of financial statement. Okay, these are all from what we have done earlier, right? You have your revenue. Revenue was from here. Sales revenue, no adjustment. So the adjustment for revenue, you need to go and do it if there are adjustments. For the cost of sale, yes, we adjust with the write down. Yeah, write down. write down of inventories, right? So it will increase the cost of sale further. The gain on fair value change, that was in information number 3 here, right? Okay, the gain. Next is the profit before tax. So you'll be able to get the profit before tax. That would be 3,960,124, and your income tax expense was from the information given in number 7, right? It will be 1 million. And the end, your profit after tax or profit for the year, it is 2,960,124, and your deficit and surplus must be shown separately because these are not related to the same asset, same land, same building. No, it is a different one. So that's why it is being done separately. You cannot offset things against each other. This is a land and this is a building. So therefore you have that being done, total comprehensive income. Now we move on to the statement of changes in equity. The statement of changes in equity, right? You will take the item that you have here, ordinary shares, 2650 from here, retained earnings, the figure here, and the asset revaluation reserve of here is the one of land. Profit for the year, this is from the calculation that you have done much earlier here, 2,960,124, this one, right? And surplus on revaluation of land will be under asset revaluation reserve, deficit on revaluation, surplus on revaluation for building, and this is deficit on revaluation, this is for land. So it will be offset against the revaluation reserve that is for land. So therefore the total reserve would be 639 for the asset revaluation reserve, and there is no change to the ordinary shares in case there is right issue, bonus issue, or any other things like a share buyback. Make sure you take into consideration. The profit for the year, there was a dividend here, interim dividend, no proposed final dividend. If there is, just include that, and be sure that you will not include the redeemable preference dividend here. Do not include because those are finance costs. Next, you will prepare your item here, which is your PPE. Your IP, as I mentioned earlier, that one would be from the information here, given here. Remember, 2050. Okay, you can straight away take this. And the current asset, there are only a few current assets here. Inventories with the write down, right? So you have 438080. Adjustment for write down is in number 4. And trade receivable, no adjustment. We assume that it is already stated at the net realizable value, and the allowance have been taken into consideration, allowance for the impairment loss, and we are just doing the adjustment that has not been yet accounted for. So we assume this is already at the net realizable value, the trade receivable. The tax recoverable, remember from information number 7, yeah, and from our journal entry, the last journal entry that we have done. Bank, we take out some cash to purchase our IP, so go and adjust that. Then we go on with our equity section. The share capital and reserve are the one from this section, 26550 here. This total of retained earnings and ARR will give you 7329068, and this total of the equity and reserve will give you the total 338,79068. Then you go on looking at the non-current liabilities. Your non-current liabilities is just your bank loan. Your bank loan, 6 million, just no other additional loan, no loan that has been repaid. If there are loan being repaid, any additional loan, you may have to also consider that. And then the current liabilities current liabilities, it should be what you have just now. We have decided it was interest, remember, it was provision for restructuring, yes, and this one is 321824. This is your trade payable, so I've not written that, so I will read right now. Trade payable, include the trade payable. There are no changes to the trade payable. Right, you have the things being settled there. Now we move on to the notes on PPE. So the notes on PPE, the first one is putting the item. So we will have to include the item here. So as at 1st of January 2020, these balance that you have here, all the balance here should have been taken from the try balance. So let's just go and show where was it from here. 15,850,5080,588,0, and the machinery was 1,004. So the balance at 1st of January 2020 is 1.4 million. Elimination of accumulated depreciation. It has to be done. This is referring to adjustment number 2B1. So if you can go back to 2B1, this one, which is the adjustment on elimination, you need to go and do that, right? Because you have now revalued the building, right? And then there is a surplus and deficit. Surplus relates to the building, deficit relates to the land. So that was under adjustment 2B2 and 2A. And for machinery, no changes. It was just as it is as at 1st of January. Let's look at our accumulated depreciation. Where under our accumulated depreciation, these are the details. For the land, no depreciation. And then the rest are the item that we have come across here. 540, 1380, 700. These are all from here. And the elimination is done for the building accumulated depreciation, since they are now being revalued. So starting from 1st of January, it is no longer based on the previous figure, but it is now based on the new valuation figure. Remember the 4.8 million here. So that gives you the new depreciation 192. For plant and machinery, I've already shown the calculation right in our workings. So you need to include here. And the carrying amount at the end of the year is going to be cost minus accumulated depreciation. 4.8 minus 192, 5.88 minus 1.968, and 1.4 minus 840. So altogether it will be 24,580. That is the one that you will transfer to your notes on PPE. With that, I thank you for watching. Remember, you need to show all the workings, especially for bank. If there are a lot of other adjustments, include all the workings, detail. You can show it either in the separate section, or you can show the workings here in an organized way, right? And same goes for inventories. Make sure you show the workings. But for the PPE, you need to show the notes on PPE. With that, I thank you for watching. I'll see you when I will see you, and wish you all the best for your upcoming final exam on this Wednesday. Thank you so much for watching. Assalamualaikum.